Hi, everyone. Welcome back. It's John with Rain King LLC. It's October 27th, time for a general market update. I'm recording this on Friday at about 11 a.m. Eastern Time, and currently the major indices are currently slightly up. Reminder, I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith, but I've been investing in growth stocks for 20 years. So our agenda is to talk about the indexes, some sectors. Going to talk a little bit about how market lows are put in. We'll get into some sentiment, some of the fear readings, trend monitor. We'll quickly go over the big eight, and then we'll wrap up. So let's dig into the sectors and some of the indices. So this is the NASDAQ composite on a daily chart showing new highs and new lows as of last night. The NASDAQ has come down about 12.4% in this correction. You'll see on the bottom panel, these are some of the heaviest net new lows we've seen all year. We have not gotten to these readings in a long, long time. There's not a lot of support in this black window, which I'm showing. We're kind of dangling in the middle here. Are we going to come down further, maybe touch the 12,002 level, or do we get a little rally here to right now, it looks like it's currently a rally within a downtrend. So the NASDAQ is kind of floating in a tenuous spot right now. Now, the NASDAQ breadth, we look at this a little closer. The line chart on the bottom in blue is the NASDAQ composite. And I've shown the NASDAQ advanced decline line, this dark line in the middle. You can see the advanced decline line has really deteriorated rapidly. And on the upper panel, I'm showing the NASDAQ. This is the percentage of NASDAQ stocks that are above a very short-term 5-day moving average. And I've drawn this line, which is kind of extreme levels where there's very, very few, less than 20% are above their 5-day moving average. And people say, well, the market's oversold. It has to rally. It has to rally. And I just wanted to look at, different similar levels when the NASDAQ got to this level with only 5%. 5 the day average and what the percent was. So you can see here that, it's not predictive. I mean, here's a very low level that we are currently experiencing today. And the market below, you said, went lower from oversold to more oversold. Then we have, we hit that level again back in May, and we had a rally. The percent above 5 days really rapidly increased, and we had a little rally in the market. Then we have another time when we've touched it, and then the market actually went sideways. So it's not predictive. Just because we've reached oversold levels and a very low level on the 5-day means we're going to rally. So we have to watch the action of price and volume. This could go up, sideways, or we could continue to become even more oversold. Now here's the S&P 500, a daily chart cut last night. So we are now below the 200-day moving average, so that's not a good sign. You can see we've come all the way back down into the support levels from April and May. Hopefully we get some support there. Again, even on the NYSE, the net new lows are very heavy, some of the biggest readings we've seen of the year. And the up-down volume, you can see, is well below 1, which really means there's no net accumulation going on in the S&P. So those are all, negative. But with that said, when you look under the surface a little bit closer, there are a few subtle hints under the surface. And this is just a start. It's not predictive at all, just things I'm observing in the market. So there are a few breadth divergences starting to emerge. And I'm particularly looking at the New York Stock Exchange advancers versus and decliners relative to the performance of the S&P. So last week we had an S&P that was down very fractionally, but the breadth of the market was actually positive. So that's a positive divergence. Now this week we had two other signs. On the 24th, we had the S&P up 0.73%, but the breadth of the market was actually much better than an S&P that was up only 0.73%. So it's better than the index. So that's showing under the surface is stronger than what the S&P was showing. And just yesterday, the 26th, the S&P was down 1.18%, but believe it or not, the breadth was actually positive. So these are just very small early signs of some breadth divergences, which maybe we might get a rally. So we'll have to take it day by day. Now here is a chart. The candles are the XLF, the financials, and the black line here is IWM, representing small caps. A couple things to notice. We talked about this 3 weeks ago. Financials and the small caps tend to both be working in tandem and correlated in bull markets. You can see coming off, this is going back all the way back to 2020, the COVID low, you can see the financials and even the outperformance of the IWM. And you can see they pretty much tracked through this bear market, though in the past couple of weeks, the small caps have really gotten hit hard and have come down to really critical support levels. We don't know if that's going to break or are we going to get some support here. So let's go a little deeper on the IWM. I put this on my X post last night. So this is the IWM, the Russell 2000 on a bar chart. And you'll notice that we're certainly in a downtrend. We're below all the key moving averages, but just noticing in the past week, we've gotten really some heavy climactic type selling. These red bars are far bigger than any bars we've seen across the chart. So could we see this as some exhaustive selling? The other thing that was of note was yesterday, we had very heavy selling again on the IWM, but somehow it actually fractionally closed up. When you get heavy volume without further price progress down, that may give us an indication that we're going to get a little bit of a bounce here, but we'll have to play it out and see how it goes. But it leads me right into my next topic. So we're going to talk about market lows briefly here. So market lows are all about the sellers. They're not really about when the buyers show up to stop the downtrend. Market lows get put in when the sellers are essentially out of the way. And there's really two ways that the sellers can be out of the way. One is you get climax selling, and everybody who wants to sell has sold. There's just nobody left to sell because they all happened and they all capitulated in one big swoop. The second way sellers get out of the way is a long, slow grind lower, and you'll just basically the market becomes sold out because all the waves lower. The sellers gradually have all petered out and the market volume just dries up to nothing and there's no sellers left. So I wanted to demonstrate the concept here looking at the NASDAQ from the December 2018 bottom. This is an example of a selling climax, exhaustion. You can see this rapid decline we had before Christmas Eve, and you can see high volume sell-off. All these sellers in here completely capitulated and they essentially get out of the way. And you notice that the ensuing rally, these first couple of days off the rally, the initial buying was actually really below average volume. And usually nobody believes it because they say, look, there's just no volume behind this. But if you can imagine that as there's a few buyers and there simply are zero sellers or very few sellers, it's like blowing on a feather. All you got to do is just blow on a feather and the market will go up. And there's nothing holding it back down because the sellers have cleared. You'll notice in this case, there was some selling a couple of days later, but it was much less than these big, exhaustive, climactic selling days. And then in this case, we got a day 7 follow-through day. And then you'll notice after the follow-through day, that's when the buyers really started to kick in and we got some decent volume and the uptrend began. So market lows are important to understand that they're really about sellers getting out of the way. They're not about buyers stepping in. So let's delve into market sentiment. I want to come back to the NASDAQ, which I've shown as a line chart in this blue panel. Here's the NASDAQ. In the lower panel, this line chart is of the VIX, this teal color. So the VIX, here we are today. We've had a correction in the NASDAQ of over 12%, and the VIX is in the neighborhood of 20. And I just wanted to show that, when you get corrections and you get some downtrends, the VIX tends to spike a little bit near the end of those corrections. You can see way back to the September, October 2020 correction, the NASDAQ corrected about 12%. And you can see we had spikes in the VIX that were actually pretty high, actually up in the 36 level, but they were certainly the first spikes were in the 30 level. But you'll notice even these short-term periods of corrective period, you can see the VIX tends to get above 28 and to 36 when we get to these really, there's fear in the market. And you'll notice in a bear market, these waves down are reducing more of that fear with each wave. So the point I'm trying to make here is that even though we corrected 12%, the VIX has been really quite tame. It's not really showing a lot of fear yet, which shows that it is possible this correction may have a little further to go. So switching to the equity put-call ratio, again, looking at sentiment, the put-call ratio, generally, when we get above 1, that means there's more puts being bought than calls. And what that means is people are buying puts because they're fearful that stocks will go down. So you can see, and I've got the upper panel showing the S&P. When you get these spikes, you tend to get a rally because everybody's on the wrong side of the boat. And you can see we've had a few spikes. We had a spike in September as we were coming down. We had a couple spikes in early October, and then things really backed off. And you can see we're not even up to 1 yet. So again, it's not showing excessive buying of puts, and fear levels are not really extreme yet, which also means that possibly the correction has further to go. This is also kind of a sentiment measure using the American Association of Individual Investors, the bull-bear ratio. Take the bulls, and then you take the bears and plot it on a line chart. Essentially what it means is when the plot is above 1, and I've shaded it in green, that means it's a bullish reading, a net bullish reading. And in the lower panel, in the pink color, is a net bearish reading. And you can see that, again, even though it's slightly bearish, it's nowhere near extreme levels. And the extreme levels that we had in 2022 are back in April and May. And then last year's big correction, September, October, and the market low in October, we had very extreme bearishness by individual investors. We're not close to that yet. So again, possibly the correction has to induce a little bit more fear before the market low is put in. Now, this chart we called up 3 weeks ago. This is just showing pre-election years. The gold line here is just showing this is generally how the S&P performs. And what it shows is between July and October, it tends to go sideways. And then usually there's a year-end rally. Here's the green line, which is 2023. We were going through this correction here, and we've come down. I guess it's important to point out, we are actually going into one of the strongest seasonal periods for the market. November, December, and January tend to be really strong months for the market. So that's encouraging. And you can see in pre-election years, they have done very well in terms of getting a year-end rally. Trend monitor. Let's quickly go through this, where we are. Follow-through day. Have we gotten a follow-through day? No, we're still waiting for a follow-through day. Watch list, we need to start the whole process over again. We're looking for bases. We're looking for strong relative strength stocks. We still have net new lows. We're still in a downtrend. We haven't seen any consecutive days above the 20-day. I slightly flagged early signs of positive breadth divergence. We'll have to see how this develops over the next week, but there are a few early signs there. And the volume profile is still showing higher volume on the down days, so that's negative. So overall, it's a very negative environment, but we want to stay engaged because we are seeing some clues that maybe we're going to get a rally, or maybe we get a follow-through day. So quick review of some of the institutional names. This is the Big 8, which had a lot of earnings reports this week. So Microsoft had an earnings gap up, which was positive, but if you look at the chart, it got rejected clearly right at the high volume close, which was 343.77. Tesla had a gap down and basically is in a pattern of lower highs and lower lows. It's in a downtrend. Google, its earnings report had a gap down. It gapped down over 9%, worst break it's had in a long time. Amazon, which reported yesterday, has had a gap up, but it's still within the downtrend of the chart. It's still below the 50-day moving average. Now, Meta reported. Now, remember, Meta tried to break out a couple of weeks ago. That breakout failed, and it actually broke through the high volume close at 309.84, which we were hoping was going to be some support, but it blasted right through and broke through it. Its current reaction to earnings has been fairly muted. NVIDIA is in a really, really important position. It's hanging on to support right now at the 1 trillion valuation, which is around 410. The eyes are on that one to see if it's going to hold. Netflix had a good earnings report. It's still above its high volume close, that gap up. And it's also one of the few of the big 8 that are above the 50-day moving average. And Apple continues to trend lower. We have lower highs, lower lows. It's clearly in a downtrend. So the Qs, which were really the trade of the year up to about August, have been in trouble. And it seems to be that money is now rotating out of the Qs. And we just have to pay attention which sectors and where is that money possibly flowing, or is it just simply being put and parked on the side? Be interesting to watch bonds, which have had heavy selling over the past few weeks. If money comes back to bonds, that might be good as yields come down. So we'll have to watch this rotation. So the summary this week, we were still in a downtrend. We still might have a little further to go until we see some more fear, but no predictions. We just have to watch day by day. The PCE report came out today. I think it shows generally that inflation is coming down, albeit slowly. And the GDP numbers have been strong. When you really think about it, if inflation continues to trend down and GDP is strong, that's a pretty good combo for stocks, because the Fed won't have to keep raising rates. They just pause for a while. So that might be a good combo if it holds up. We're still waiting to see signs of a market low and trend change. We know what we're looking for. We are entering a seasonally strong period for the market, so that's positive. And we want to be prepared. You want to start going through your process, do your screens, build your watch list, looking for high relative strength stocks. And, we're looking for a follow-through day. Remember, we're always only 4 days away from a possible another leg in a bull market. So we always want to be on our toes and stay engaged. Exposure levels should be really, really low. I'm in cash. You don't want to fight the market. Cash is really a good position. Cash is king at the moment. But that's the summary for this week. So the quote of the week is, the market makes the news doesn't make the market. I also wanted to give you a last reminder that a week from Saturday, November 4th, is the BlueSky6 event. This is a virtual event. We've been doing it for 6 years. And the event will be recorded, and we will have videos available for a couple months post-event, but you have to register to get video access. And I've got the agenda here. It's a powerful agenda, some great speakers. John Boyk will share a lot about history and lessons from history. Gil's going to share his new OWL trading platform of long and short ideas and how he trades the markets. And then we have a very special interview, table talk with David Ryan and his son, Sean. I think this is a rare occasion to see both of them together in an interview format. Then we have Kenny Polcari, who's a New York Stock Exchange former floor trader. He does great weekly, daily market updates. You should check those out. I've posted them on my X feed, and he'll tell some great market stories. Andrew Roca is going to get into artificial intelligence, and we'll compare it to some of the build out of the internet. And I'm going to do a presentation called The Irrational Behavior of Rational People, talking about our biases and some of the things in the market that we all struggle with from the psychology point of view, and some tips on how to work on those. Then we'll get to power picks. Power picks are each speaker will give one idea, one of their best ideas in a 2-minute pitch. Then we'll wrap up. And then post-event, we're going to have a separate webinar on Zoom called Blue Sky After Dark, which has really become a tradition for Blue Sky, and featuring Jason Thompson of Ticker Monkey. So that's not to be missed. There's so much to be learned from Jason, and we talk stocks for another couple of hours. So if you want to register, go to my X post. My handle is @jpoco722, and my top of my profile is a pinned post that has the registration link. If you don't have X, then please just email me at RainKingBullBear rainking@gmail.com. So here's the email again. If you want to get that registration link in an email from me, rainking@bullbear.com. I hope you enjoyed this general market update. It's October 27th. Have a great weekend, everybody, and we'll see you next week.